Good afternoon, everybody, and thank you for joining us for this week's Wednesday Wisdom webinar entitled How to Access Capital to Grow Your Firm. I'm Judge Jennifer Kuyrkendall Griffin, and I am moderating this free CLE on behalf of the Solo and Small Firm section, of which I serve on the Executive Council. We are an elite section of the Florida Bar that offers a number of great opportunities and resources, especially to those who are solo practitioners or in smaller firms. Please check out our section or get more involved. As to housekeeping matters, the audio feature is turned off for participants. So if you do wish to ask a question of the speaker, you will need to type it into the Q&A section of Zoom. All questions will be addressed as close as I can get it asked to when you ask the question, but I'll just wait until there's a natural break as our presenter is speaking. I would like to recognize our sponsors whose logos are included on the slide that you see here, and that's for their contributions to the section this year. We have Florida Lawyers Mutual Insurance, InfoTrack, Clio, Aligned CPA, CIO.legal, Alonzo Appeals, Field Legal, Gilbert Garcia Group, Massey Law Group, RT and AP Mediation, and Law Group. I encourage you to explore the member benefits offered by the section's sponsors. Our speaker today is Scott Leitner, who is the Senior Vice President, General Counsel, Attorney Business Banking for Climate First Bank. As a licensed Florida bar attorney, Scott has a diverse background in both law and business. A graduate of Lake Mary High School, he attended the University of Florida and graduated with a degree in business administration in 2002. Following undergraduate school, he worked in the construction products industry for a number of years before attending law school at Florida A&M College of Law. Upon his graduation, in 2011, Scott worked at a mid-sized consumer law firm in both the loss mitigation and litigation departments, helping clients with their real estate, foreclosure, and consumer debt-related matters. In 2016, Scott joined Ken LaRoe at First Green Bank and helped launch its attorney banking services department, specializing in providing banking services and products to attorneys and law firms all across Florida. Scott has extensive knowledge in driving environmentally focused banking initiatives and uses his wide array of experience to provide his clients with the banking solutions needed to make their business successful. Scott and his wife, Leah, are both involved with many of the voluntary bar associations in Central Florida. They also enjoy outdoor activities, sporting events, concerts, and of course, rooting for the Gators. So at this point, I'm going to turn things over to Scott. And remember, as you have questions, if you will, just put them in the Q&A.
Thank you, Judge Griffin. I appreciate the introduction and welcome everyone. I'm excited to be asked to present today on how to access capital and grow your firm. This is a perfect topic for me, as this is basically what I do, is help law firms, that are either just starting or trying to get to the next level through growth, by providing the funding they need or just the banking relationship needed to get their firm to the levels that they're trying to achieve. So I made a few slides, but I'm going to try to keep this really interactive. So please feel free to fire away with any questions, and Judge Griffin will read them, and I'll address them as they come in. But I made this slide. This is really just a list of comprehensive products that banks provide. If you own your own firm or any business in general, obviously you're going to have a relationship with a local bank. Everything from all of your personal banking, but mainly we're here to talk about, business banking. And there's really 2 or 3 sides to having a business banking relationship. Obviously, there's the deposit side. And as attorneys, we know there's the operating account, and most importantly, the IOTA account, the interest on trust, attorney trust accounts. We all know how important that is, not screwing that up, not getting yourself in trouble with the bar for misappropriating funds or accidentally debiting funds from that account. So having a bank that understands the importance of properly maintaining that account is obviously very important. But why we're here today is really to talk about different lending options. Everything from commercial loans to personal loans. The other third category really is cash management solutions, and that would be doing things like ACHs, wires, what we call treasury or business banking, fraud protection, which is very important. So if you have any questions on any of that, I'm happy to answer. But what we're really going to focus on is the lending portion of what banks can offer to law firms. Whether you're just starting a firm and you need that capital to, you know, uh, put everything in place as far as leasing an office, getting equipment, furniture, or perhaps you just need some money for marketing. You want to get an ad on TV, or you want to put a billboard, or you want to advertise in some publications. Um, you're going to need some capital if you don't have cash on hand. On the other side of things, if you're an existing firm, let's say you're a personal injury or a trial attorney, you take on contingent cases, you're going to want capital to help fund all of the costs, whether it's the filing fees, expert witnesses, travel, some of these contingent cases, especially in the more complex matters, whether it's med mal, construction defect, you're going to ring up tens, if not hundreds of thousands of dollars in expenses up front. So having a line of credit or something along those lines to help support those costs until you reach a settlement or a judgment is going to be super important. So let's start with the basics. When someone comes to me and says, "Hey, I'm thinking about leaving the firm I'm at. I want to go out on my own, hang my shingle. I need to get a loan. I have, I want to have some money to hire some staff, get some equipment. I want to, furniture, whatever you need. Um, you know, we'll talk about what types of products are out there. The first thing I'm always going to look at is a conventional loan. That's just a typical loan that the bank can offer. And what the bank is going to look at is this appropriate for a line of credit, or is it more something that we need to do a term loan on? Something that, can provide payback. The difference between a line of credit and a term loan is a line of credit, you're going to have access to capital. It's almost like a credit card. You borrow money, you just pay interest on what the balance of that card of that loan is currently outstanding every month. You don't actually pay down the principal balance. And so it's supposed to revolve. So you can borrow against it, use the funds. Let's say a couple months down the road, a case settles, you're able to pay that balance down. Obviously, you want to try to keep the balance as low as possible because then that will reduce your monthly interest expense. So I'm going to switch to this slide. Basically, it's the different types of loans that banks can offer you in general. So we'll start with the second one because we already started talking about lines of credit. So there's the revolving line of credit, both business, we talked about roughly. And then there's also what people don't really realize is a home equity line of credit using your personal residence as a means to borrow money. It's actually the largest small business loan in the country. A lot of people that are starting a business or need access to capital are going to tap into the equity in their personal home. Most banks will lend up to 80% of the appraised value. So, for example, let's say your home is worth $500,000, but your mortgage is only 200,000. Well, 80% of 500 is $400,000 minus whatever the existing first mortgage is, which is 200. That leaves you over $200,000 to access on a home equity line of credit. And most banks will provide that as a 10-year interest-only facility. So you could borrow against the house, get the cash up front or as you need it each month, and you only pay equity, or I'm sorry, interest on the amount that you borrow. So similar to a business line of credit, you're gonna just pay the interest each month on the balance. If you pay it down to zero, then there's no payment at all. If you have an outstanding balance that you're carrying month to month, then you'll continue to make those interest payments. And then if you fast forward to the 10 years, then at that point the loan balloons. You'll have to pay down the full principal amount, or the bank may offer you to term it out over a period of time, or maybe you could even renew it for another 10-year period. So home equity line of credit is always a great way to access capital. But you may say, I don't really want to use my personal home as the vehicle to borrow money for a business that I'm starting, whether it's a law firm or some other business. So then we could always look at a conventional revolving line of credit. Typically, when a bank is going to look at a line of credit, the first thing I'm going to say, talk to a client is what are you using the money for? Make sure it's an appropriate use. And then I'm going to ask them to submit a list of financials that the bank's going to want to review with underwriting to see if the client is going to be approved for the loan. Typically, that would be 3 years of personal and business tax returns, a profit and loss and balance sheet for the most recent period, um, and then a personal financial statement. So I'll quickly go through those. Obviously, business tax returns, we're going to want to look at the last 3 years. So as of right now, most people would have their 2021, 2022, and 2023 business tax returns to share. They may not likely have not filed their 24 yet. They may be on extension through October of this year. So if they don't have them, we'll just say send us the 3 prior years. Same thing with personal tax returns. And then a personal financial statement. Basically, that's a form that we send out, or banks will send out, that you will put all of your personal assets and your personal liabilities. So we're going to want to know what your liquidity is. How much cash do you have in the bank? What other assets do you have? Stocks, investments, other businesses, real estate that you own personally. And then on the other side of the sheet, you're going to list all of your liabilities. Any notes outstanding, mortgages that you may have on the real estate, any other debt like student loan debt. And that's how we calculate what the net worth of an individual is. And then later in the sheet, you'll also see things that ask you to list out, life insurance, any other assets that you may have, artwork, jewelry, cars, things of that nature. So that gives us kind of a snapshot of a borrower's personal, really financial life. It kind of gives us that. And then obviously that also gives us the okay to pull credit. When we do a review, we always look for credit scores. You're going to want a credit score north of 700 in most instances. And then lastly, we'll likely do a background check. We use LexisNexis, gives us every detail, parking tickets going back 30, 40 years, any other criminal activity, any judgments that may be outstanding. So it really kind of gives us a full picture of who we're attempting to do business with. And that's important. When a business is entering into a relationship with a bank, the bank really wants to know everything about the borrower, especially on a line of credit, because typically, if we move forward and approve it, the line of credit is secured by a UCC filing on all business assets. So we're going to file a UCC with the state. It's going to encumber all of your business assets. But when it's a law firm, what are actual business assets? Your desk, your computer. Ultimately, if you default, we have the ability to come in and sell those items, but we're going to get pennies on the dollar. It's not going to likely pay off the loan. So that's why banks really have to be comfortable in doing a conventional line of credit, because the collateral um, is minimal on a law firm. It's not like it's a company that has a ton of let's say we were doing a line to a heavy machinery company where we have a bunch of backhoes and excavators and trucks and other vehicles as collateral. With a law firm, it's desks, computers, artwork, other furniture items. So there's not a lot of collateral. Um, but that's basically how both, a home equity and a revolving line of credit works. I'm going to jump down to the government guaranteed lending. This is another option that we look at, specifically the SBA 7A program. So the SBA stands for the Small Business Administration. It's part of the federal government. Obviously, with the change in leadership right now in DC, the SBA has been going through some changes. If you have any questions on that, I'm happy to answer. But they're updating who can qualify for SBA loans. I know they've changed the residency requirements. For example, it used to be a business needed to be owned by 50% by a legal US resident or citizen. I believe now it needs to be 100%, so you can't have any foreign investment. Typically not a problem for a law firm, but we do run into issues with other types of businesses where foreign investment is common. So the benefit of an SBA loan is that it allows the government to back the loans, in some instances up to 75%. So it makes the bank comfortable because we know if the borrower defaults, that the government's going to step in and cover up to 75% of the loan. So it gives us a little bit more leeway on who we decide we're going to lend money to. Particularly, it's great for new startup businesses. What the program allows, I mentioned earlier, on a conventional line of credit, we're going to look for 3 years of historic financials. We're going to want the 3 years of business tax returns. We're going to want to look at how that business has performed. And the main number that we look at a tax return is net income. We want to know what the business actually earned each of those periods. And can they service the proposed debt? Without getting too deep in the weeds, we look at what a term called EBITDA. It's your earnings before interest, depreciation, and amortization. So it's net income plus some add backs. Then we look at what the debt service is for that company. So if you have an existing mortgage, or let's say you have another outstanding debt, let's say there's some credit card debt, we're going to calculate what those annual debt payments are, plus what is the annual debt payment of the facility that we're looking at to provide. And we're going to divide that into the EBITDA figure. Let's just call it net income to keep it simple. And that gives you what's called a debt service coverage ratio. And a bank wants to make sure that you can pay all the debt plus 25%. That's the typical coverage ratio, is a 1.25 times. So it's getting a little deep in the weeds there, but in general, that's what the underwriter is doing when they're calculating, can a business qualify for a loan? So the benefit of the 7A program is that you don't need to have those 3 years of historic tax returns to look at. You can prepare a business plan and include in that plan 3 years of future projections. The SBA is going to want the first year projected out monthly. Year 2 and 3 can be projected out annualized. But they will actually underwrite the loan based on what you project this new business is going to do. So for someone that's starting up a law firm, they come to me and say, hey, I need to get a line of credit to help get this firm off the ground. I have a list of things that I've budgeted for, marketing, hiring employees, getting furniture and computers and systems, in place, whatever else is needed. We can put together a business plan, projections, submit that to the SBA for review, and they'll potentially approve based on those projections as long as they're in line with what they think is reasonable. So SBA loans are a great option for a new startup business or even an existing business that's looking to grow to a new level. Let's say you're merging with another firm and you need to buy out the existing partners that are selling the firm, or some of the partners may be leaving, whatever the case is. An SBA is an option as well on that. You could say, look, here's an existing successful business, but we need to make a large investment in order to grow and gain this additional company that we're going to incorporate. And again, you could put the projections in place and they'll underwrite based on those projections versus the historical figures. So between the conventional line of credit, the home equity line, and the 7A program, it's really three great options to access capital, for revolving lines of credit, interest-only facilities. So if you have any questions on anything along those lines, please feel free to reach out. Another very popular lending category is going to be real estate financing. I think every attorney I deal with at some point wants to buy an office building, wants to buy their office condo. Because why, just like when you in your personal life, you don't want to necessarily rent forever. You want to buy a house, you want to build equity, you want to, that usually your home or your commercial property is going to be one of your larger assets. And the way we've seen properties appreciate in Florida, it makes sense to own real estate. It's going to go up in value. We've seen periods in time like the Great Recession where real estate values have gone down, unfortunately, but if you're patient, it's always gone back up. And everyone that kept properties throughout the recession, most likely they've doubled in value to date. So we've seen real estate could be volatile, but in the long run, it's a safe investment and it's a great way to build wealth. So a lot of times attorneys will say, hey, I have the opportunity to buy the building I'm leasing, or I want to go out and find a building to house my practice. So then the first thing I'm going to ask them is, well, is this property that you're looking to buy, is it just for your firm? Or potentially is it an office building that has 5 or 6 suites and you're going to occupy one or two of them and you're going to lease out the others? Because that's another great way to generate revenue is to become a landlord. You can have your firm in the property. You may have 4 or 5 other types of businesses that occupy and pay rent. So there is a difference though. You can see where I wrote owner occupied versus investment. So to be considered an owner occupied piece of property, the business that's buying the property needs to occupy over 50% of the square footage. So if someone came to me and said, hey, I'm buying this office building, I'm going to occupy the majority of the square footage or all of it, perfect. We can do a conventional owner occupied commercial real estate loan. We can lend up to 85% of the value of the property or the cost. We can amortize that out for 25 years. Typical terms, usually on commercial real estate, it's 5-year terms. Sometimes we can go out to 10 or maybe even 15 on certain types of loans. So there's some flexibility there. Um, but again, we're going to look at historical financials. Can this business, based on the last 3 years of tax returns, support the additional debt that's going to be added? And we do the same analysis. We look at the net income for each period. We look at what existing debt you have. We look at the proposed debt. We calculate that debt service coverage ratio and we see does it meet our 1.25 guideline. And if it does, you're in good shape to get approved and we can proceed with purchasing the property. There's obviously title work, appraisals, environmental reports. There's a lot that goes into buying commercial real estate, but we handle most of that. And in the end, we go to closing, you buy the property, and you're off and running. You may buy the property and say, hey, I want to actually make some improvements to the property. Well, we can even calculate that into the loan amount. Let's say you're buying a building and it needs $400,000 or $500,000, needs a new roof, needs a new HVAC system, interior needs to be updated and redesigned. We can actually incorporate that into the loan amount. If your contractor can provide a budget and what they feel like all the renovations are going to cost, we can actually submit that to the appraiser company, and they will calculate what the not only the as is value of the property, but they're going to calculate the as completed. So they'll appraise it based on what the value will be after all of the renovations are done. And we can actually lend up to that as completed value. So there's definitely the possibility of buying a property that needs some work and not having to come out of pocket to do those renovations and improvements. So keep that in mind when you're on the real estate hunt. Those are things we can obviously look at. On the other side of the coin is an investment property. As I mentioned, it's something where you're not going to occupy more than 50%. Let's say you're going to have one suite and you're going to rent out the other 5 or 6 suites. Maybe they're already rented out. You're buying the building, there's already leases in place. Could be a great opportunity to, again, to not only have a house for your firm, but to be a landlord and use the lease revenue from those other tenants to cover some or all of the mortgage that's going to be in place when you buy the building. Um, it's a little different. Terms are similar. For example, on a owner occupied, like I said, we'd lend up to 85%. On something like an investment property, you'd probably be a little lower, like 75% loan to value, loan to cost. So you would have to put a little bit more money down on something like that. But again, you do have the benefit of other tenants paying you lease payments monthly, which would obviously help cover your mortgage payment. So something to also consider is an investment property. Now, let's say, funds are tight, and you want to buy a property. It's got to be an owner occupied. That's where the SBA 504 program comes into play. It's for businesses to buy commercial properties, that will be owner occupied. So again, you have to occupy more than 50% of the square footage. Um, this program is great. It will finance up to 90% of the purchase. So for example, you find a building, it's $1 million, you want to buy it, put your firm in there, but you only have maybe 100,000 for the down payment. Well, conventionally, you wouldn't be able to make that loan work. You just wouldn't have enough equity to put in. On the 504 program, that would work great, because what happens on that is there's two mortgages. The bank would do a 50% first mortgage. And then the SBA, Capital Development Company, there's three or four of them in Florida that we use, they would do a 40% second mortgage. So you would only have to come to the table with the 10% equity. You would have a first and a second mortgage. The second mortgage, the 40%, the SBA offers a 25-year loan, fully amortized, meaning that there is no balloon payment. You pay the rates fixed for the full length of the loan. The rates are usually very favorable. And so that loan's good to go. The 50% first mortgage has to be a 10-year loan, also a 25-year amortization, with a fixed rate. So that's a good way to obviously buy something, and finance, up to, like I said, 90% of the property. So that is really, other than lines of credit, commercial real estate financing is another big category that I run into with law firms that are really looking to take it to the next level. So, Judge Griffin, is there any questions at this point?
I was able to answer it, but I will ask you, are you okay with us sending a copy of your slides out to everyone?
Yeah, absolutely. If you go to the last slide, I actually included my a QR code that you guys can scan. It will give you all of my personal information. So if there's any questions that you don't ask today or that you think of down the road, feel free to reach out to me directly, and I'm happy to have a conversation about any of this or any banking matter.
Wonderful. Thank you for that. And so for all of the attendees, we have your email addresses since you registered with us. So I will now send the PowerPoint to our program administrator, and we'll make sure that they get sent out to today's attendees. But that's all of the open questions right now.
Perfect. Okay, I'm going to go on to the next slide. So here's just some other options that we occasionally encounter. Equipment financing. So not so much with law firms. Occasionally I'll have a firm. I did one of these recently. The attorney wanted to buy a company vehicle under the firm. That goes under equipment financing. So you could finance, a new truck or a new vehicle that you're going to use for business purposes. And that's something we can finance 80–90% of that. Similar review, we're going to look at personal and business tax returns. We're going to look at a 2024 year-to-date profit and loss and balance sheet. We really haven't talked about profit and losses and balance sheets. I find a lot of small firms will just use QuickBooks, which is fine. You get a company prepared. You can ask QuickBooks to populate a profit and loss and a balance sheet. The profit and loss basically is shows all of your top line revenue and all of your income that comes in. Then it goes through all of your expenses. And in general, it calculates what your net income is, your total revenue minus total expenses. That's what your net income is. It's company prepared. Is it the most accurate thing to look at? No. We'd much prefer tax returns or CPA prepared audited statements. But for a small business, you're typically going to have a company prepared profit and loss, whereas the balance sheet is as it states, it's going to show the balances of all of your assets. So it's going to show bank accounts, any notes receivable, notes payable, and it's going to all balance out. So that's just another tool that we look at to see, kind of the health and wellness of a company when we're underwriting for a loan. So again, we look for 3 years of tax returns, 2024 profit and loss and balance sheet. In another few weeks, I'm going to start asking people that come to me for a loan. Now I'm going to need 2025 quarter one. So I'm going to say, send me your profit and loss and balance sheet for Q1. We're going to want to see January, February, and March. And we'll take a look and see how a business is doing through the first quarter. But equipment financing, we can look at, like I said, anything from furniture, technology. Maybe you're going to buy a number of computers or other advanced software that your firm needs. Those are all things that we can help finance. Technically, you could just use a line of credit, but for some of the larger things like a vehicle, a line of credit's not really appropriate because it's an interest-only payment. It's supposed to revolve. It's supposed to be something that you pay down, month to month. A lot of times lines of credit will have a rest provision, which will say you need to pay the line down to zero for 30 days a year. We want to see that the borrower can actually rest the line and they're not just going to max it out. And that's the last thing a bank wants to see. If we give you a $300,000 line of credit, we don't want you to max it out at 300 and it just stays there. Granted, the bank likes the fact that they're getting the maximum interest payment. We're going to make a lot of money off of that loan, but that's not the appropriate use. You're supposed to use it, pay it down, and let it revolve, as the name suggests. Another thing, maybe a little bit more specific to Climate First Bank, but I know some other companies do it as well, solar financing. And I've done this for a number of attorneys. They buy a building, and we'll approve for them to put a solar array on the roof, maybe a couple of EV charging stations so your clients or your employees can come and plug their electric vehicles in and charge them. It really just makes the building more efficient and saves you on electricity costs. So you could put an array on your roof. You also will qualify right now, at least, it's a 30% federal tax credit. So it's a way to reduce your tax liability on a solar system. We'll see how this administration, whether they continue to keep that in place, but at least through next year, it's a 30% tax credit on a solar and an EV station that you may install. Really the best benefit, not only are you being a good steward of the planet and being green and reducing your carbon footprint, but really you're reducing your electricity costs because instead of paying the power company every month hundreds, if not thousands of dollars for electricity, you could produce your own. And as long as you're, whatever the balance is, then obviously you tap into what the utility is providing. The other big benefit that people don't realize is, Florida Power and Duke, they're always constantly going back to Tallahassee and asking for rate increases. I think Florida Power just went in for one of the largest rate increases they've ever asked for. They'll probably get some, if not all of that. Well, if you have a solar system on your home or business, rate increase doesn't really matter to you because you're producing your own energy, you're using what you produce, and the cost of electricity really doesn't come into play anymore. So that's something to consider. And then obviously, I have on here personal lines of credit. Not typically used for businesses, but it is a way to access capital. And we offer both personal, and most banks do personal and executive lines. These are really based on your debt to income ratio and your credit score. We're going to want to see your proof of income for maybe the last year or 2 years. We're going to want to know what all of your debts are so we can calculate that ratio. The credit score speaks for itself. We're going to want someone that has, a high credit score and good marks there. And so you can qualify for a personal line. They're unsecured. And so Whereas a HELOC, a home equity line, is secured by your house. You default on that, the bank can foreclose on your house, sell it, get paid their money back. Obviously, the first mortgage gets paid first, and then we come in and get the balance that's remaining. And then if there's anything left, the homeowner obviously will get to keep that equity. Typically, though, luckily most I think people have, unless we end up in another great recession situation, most people, the reason why banks like home equity lines of credit, the last thing people are going to default on is their primary residence. They don't want to lose their house. Um, so, personal lines really for people that have really good credit, good income, low debt. Those are the people that really could qualify. Could you use that for a business purpose? Sure. But you're probably better off using your um, business, revolving line of credit or an SBA 7A loan to help fund business purpose needs, or the personal lines more so for, personal use or any kind of project that you may have going on. Um, so that is really the different types of financing that banks can offer to attorneys. Again, it's real estate, it's lines of credit, it's the other specialty needs, equipment, solar, personal lines. So really, I'm hoping there's a couple of questions out there that I can address, or maybe some scenarios that you guys have that I'd be happy to discuss. Anything that's come in, Judge Griffin?
Nothing has come in, but I can come up with stuff off the top of my head.
Yeah, if you
What
have something.
what what would you say in general the interest rates are right now, or is that more dependent specifically on the credit score?
Yeah, so in general, I don't know that we change affect banks yes, there's a little bit of flexibility with credit score. Someone that has great credit is going to qualify for a little bit of a better rate than someone that doesn't. In general, for business lines of credit and commercial real estate, there's just going to be a cutoff. If you don't have a 700 plus, you're probably not going to get, unless you have a great explanation. And we've seen that. We've had someone come back with the low credit score and, it had to do with maybe their student loan servicer changed and their payments weren't getting reported. So if there's a good explanation, we can overcome that. But if it's just you've got 50, 30-day, 60-day, 90-day late pays over the course of the last 7 years, that's going to show the bank, you haven't been a good steward of your lending. That's going to give us some pause on whether we want to give you more loans. So interest rates though. So right now, for example, when I do a line of credit for a business, the rate floats. Typically, we use the Wall Street Journal Prime is the index that we use in most options. And right now, prime rate is at 7.5%. And usually the rate will be typical for a law firm, prime plus one. So it'll be whatever the prime rate is plus 1%. So right now that would be 7.5 plus one. So it'd be an 8.5% floating rate. That rate will change every time the Federal Reserve either increases or decreases rates. So there was, I think, 2 or 3 decreases last year. At one point, prime was up to 8.5. I think now it's down to 7.5. I think the Fed has indicated 2 more rate cuts this year. So we could potentially see, typically they do quarter point cuts. So we could see prime go down to maybe 7.5, or I mean to set from 7.5 down to 7, which would put your interest rate on a line of credit probably around 8%. On commercial real estate, typically it depends. Owner occupied real estate where the firm's going to own or occupy more than 50%, the rates are right around 8%, and it could go plus or minus half a point. I just got a loan approved last week for a law firm here locally, and they had, their numbers were great. They make great net income, credit scores were great, personal guarantors, were solid. They got a rate of 7.75. So we're going to be in that 8% range. Um, that's just where the market is right now. But if you think about a line of credit at, excuse me, 8.5% versus what a credit card interest rate is. So if you've been using your your Amex to fund your business and to float costs, and you have a balance that rolls every month, that rate could be north of 20%. We've seen credit card rates closing in on 30%. So a business line of credit through a bank or credit union is typically going to be a much lower interest rate if you're going to have a balance that rolls every month. If you pay it off in full, then you don't really care about interest rates because your balance is going to be zero at the end of each month.
Right. Thank you for that. And we've got several questions that have now come in. First, can
Great.
you go over the coverage ratio again?
Sure. So it's called a debt service coverage ratio. And what that formula is, it's EBITDA, which for all intents and purposes is your net income. So if you, for example, look at your tax return or look at a profit and loss, the bottom line that says net income, you're going to take that number. There are a couple of add backs. So if there's interest or depreciation, you can add those back in, or amortization. But for just to keep it simple, net income, and then you're going to divide that by annual debt service. So what is annual debt service? So let's say you have a credit card right now that if you take it the monthly payment times 12, let's say you're paying $4,000 a month on a credit card balance, that's 48,000 annualized. Let's say you have an existing mortgage on your building, that's 5,000 a month. Annualize that, that's 60,000. So now you have a existing debt service of 108,000 plus, let's say our proposed loan, let's say we're looking at a 500,000 line of credit. And just to keep things simple, I'm going to say, okay, the monthly payment on that maxed out would be $5,000 a month. So again, another 60,000. So now you're at 168,000 is your existing and proposed annualized debt service. So you would divide your, let's say it's 200,000. I'm going to open a calculator real quick so I can do it. So let's say your net income for the year is 200,000. You'll divide that by the 168,000 of debt service, and that gives you a 1.19. So your debt service coverage ratio would be a 1.19 times. So in that situation, you're a little below bank policy. Most banks are going to be around 1.25. So we may come back and say, okay, you really 500,000's cutting it close. We're more comfortable at a 400,000 line of credit. This is what we can offer. And let's see how things go. And we'll re-review your financials every year. You're going to have to resubmit your tax returns and financial statements for an annual review. So we'll take a look and maybe we can increase the line next year. And so that's typically how the debt service coverage works.
Thank you. Could you please elaborate on the necessary qualifications for a line of credit, especially for a solo practitioner? And as an example, lots of potential clients, but not enough time to deal with them all and need to hire support staff.
Yeah, so that's where things get a little tricky because if we look at a conventional line of credit, again, it's going to be the review of your past 3 years of business tax returns, 3 years of personal tax returns, and then your year-to-date profit and loss and balance sheet and a personal financial statement. So that's going to be the initial package that a bank's going to request from you. They're going to say, we need all of those items and we're going to review. They're going to calculate that debt service coverage ratio for every period for those 3 or 4 years. Um, and that will help you qualify for a loan based on your historical financials. Now, let's say you're so busy, you're trying to get the firm to the next level, you're trying to hire more staff. That's where that SBA 7A program can be helpful because not only can we look back historically, but you could prepare a business plan and have future projections that show with this additional staff, I'm going to increase my revenues and net income over these periods. And the SBA will actually look at those figures and determine whether you can qualify for a larger line of credit based on the future projections.
Thank you. What is the typical amount that a bank would lend to a solo practitioner starting a firm? Does the amount depend on the lawyer's experience, reputation, etc.?
It really does. So, for example, let's say you're a 10-year attorney, you've been at a big law firm, very successful, you're making a great income, and you're going to start a firm. We may not necessarily say you have to go with an SBA loan because you have no historical business financials, this is a brand new startup, we may look at this person and say, yeah, this is a new startup, but they've had a very successful career, they've made a lot of money. And I didn't get into this before, but we look at when we analyze business and personal, obviously we're looking at the business is what's most important, but we also look at the personal as well. And then we do what's called a global, where we combine the two together. And so we do both personal analysis, business analysis, and then a global. So someone that's really strong and has a lot of experience, the bank's going to be more comfortable with them doing a conventional line of credit or a conventional loan in general, because we know ultimately, even if the business, for whatever reason, they end up closing shop, they can easily go back and get another job making, the salary that they had prior. So we're comfortable looking at someone that has that track record, that can support the debt with their current, and existing income. Another factor that we look at too is just liquidity. How much cash does this person have in their bank? Because ultimately, if they're sitting on a big pile of cash that can service the debt, and we'll look at that and say, well, even if they make zero income for the next 12 months at their new startup, they still have enough personal income to cover all of the debt that they're looking to take out. So that's important too. So we kind of take all of that into consideration. Now, if it's a brand new attorney, they've only, let's say, or maybe even they're their 2-year attorney, they've been at the state attorney's office. Unfortunately, their salary is not huge. They haven't saved any money, but they're going off and opening up their own criminal defense firm. They want a line of credit, and there's not a typical amount. I see a lot of people say, I want 100,000, 150, 200. I'd say that's kind of the typical starting spot for an attorney that's starting a firm. They're probably going to need the SBA financing because they just don't have the track record. They haven't shown the ability to make the income needed to support that debt. So the SBA program is the way to go there.
All right. Well, I don't see any more open questions at this point in time, but I would like to thank you, Scott, for sharing your knowledge and providing this important program to the Small and Small Firm Section members, and also thank each of you for participating in this Wednesday Wisdom webinar. Again, that is provided to you at no cost by the Solo and Small Firm Section. We hope that you found this program helpful and welcome any suggestions for future programming. You will need to log on to your Florida Bar member portal and enter your own CLE credit. And again, the course number for this is 8720, and it's good for 1 CLE credit. You've got the QR code right there right now if you want to go ahead and snapshot it to take you directly to Scott's information. Otherwise, we are also going to be sending out a copy of the PowerPoint that has it at there's the right QR code. That the PowerPoint will be sent to you, and then you can contact Scott directly if you have any additional questions. But thank you today, Scott, for a great program, and good luck for all of you that are looking to expand and do bigger and better things.
Thank you, Judge. Thanks everyone for attending, and feel free to reach out with any additional questions, and I'm happy to have a conversation.
All right. Thanks, everyone. Have a good day.
Thank you.